What if the stock market crash you're seeing right now isn't the start of a disaster, but the beginning of one of the biggest wealth opportunities in years?
All right, let's just get right into it. You can feel it, right? There's this anxiety in the air. Oil prices are going nuts. The stock market's taken a dive. I mean, it's down over 14%. And a lot of us are just kind of looking at our screens going, what on earth is happening? So today, we're going to break down that connection, between these crazy oil shocks and recessions. And more importantly, we're going to look at how a seasoned investor actually thinks about navigating this whole mess.
And this quote, this is from Larry Fink, the CEO of BlackRock. We're talking the biggest asset manager on the planet. And what he's saying here is just, wow, it's incredibly powerful. He's basically laying out two completely different futures for the economy. On one hand, you've got oil hitting $150 a barrel, which could trigger a really deep recession. On the other hand, maybe things calm down, oil drops, and we see some strong growth. So the big question is, which path are we on? Let's dig into how this actually works. So let's say we are heading towards that scary $150 oil number. Why does that pretty much guarantee a recession? Well, it all comes down to this predictable chain reaction. It's like a set of economic dominoes just waiting to get knocked over. Okay, so let's walk through this domino effect step by step. First up, high oil prices. That doesn't just mean you're paying more at the pump, right? It makes everything more expensive to make and ship. We're talking groceries, clothes, gadgets, you name it. And that, my friends, is inflation. So what do governments and central banks do to fight that? They start raising interest rates. Okay, domino number two. Now, higher rates make it more expensive for companies to borrow money for, building a new factory or hiring people. So what happens? They pull back. They cut spending. They slow down hiring. Domino three. And that, of course, leads to job losses, or at least fewer jobs being created, and people start spending less money. Domino four. And once the flow of money in the economy slows way down, GDP falls, and boom, that's it. That's your textbook recession. See how it all connects? And this chain reaction can lead to the absolute worst case scenario. It's a word you might have heard thrown around, stagflation. And man, it's a toxic economic cocktail. It's where the economy is shrinking, or at least not growing, but prices are still skyrocketing. It is literally the economic equivalent of being stuck in quicksand. And it's a very real danger if these high oil prices stick around for a while. So look, this isn't just some economic theory we cooked up. To really get a handle on what's happening now, we can actually just look back through history. And what's amazing is that when you look at what happened during past oil shocks, the data paints an incredibly clear picture. Just look at these numbers. Back during the OPEC embargo in the 70s, oil prices went up 4 times. The S&P 500, it got crushed by almost 50%. Then you have the Iranian Revolution in 79, another huge stock market drop, 27%. Fast forward to the crisis in 2022, and you see a 25% decline. The pattern here is, well, it's undeniable and it's painful. A massive spike in oil almost always comes with a major hit to the stock market. And that 2008 shock, wow, a 57% drop in the market. That's just brutal. But it's really important to add a little asterisk here, right? That wasn't only about oil. It was also happening at the exact same time as the global financial crisis and the US housing market collapse. So that all just poured gasoline on the fire and made the fallout way, way worse. Okay. So we've laid out the problem. And yeah, the historical data it's pretty sobering. But for an investor, this is actually where things get interesting. Because panic is never a strategy. Instead, this is the exact moment when you pull out the playbook for market turmoil. And this really is the million-dollar question, isn't it? When fear is cranked up to 11 and everyone else is selling, where does a rational, data-driven investor find the opportunities? Because trust me, they are absolutely out there if you just know where to look. The first thing you have to burn into your brain is that market drops are normal. They just happen. A smart investor doesn't see them as a crisis, they see them as a sale. The key is to look for these technical support levels. These are basically price points where the market tends to find its footing and bounce. And guess what? Right now, the S&P 500 is sitting right on its 200-day moving average. All that means is it's at the average price of the last 200 trading days, and historically, that's a huge support zone. Now, this doesn't mean you dump all your money in at once, no way, but it's a great signal to maybe start buying in little bits. Buying in zones, averaging down your cost. And why? Because some of the best companies in the world are suddenly on sale. And I've got a perfect, absolutely stunning example for you. Take a look at Microsoft. For the first time in over 13 years, the stock is trading below its 200-week moving average. We're talking its average price over the last 4 years. This is what a lot of pros would call a generational opportunity to buy one of the best companies on the planet, a discount that's only happening because of all this fear in the market. Okay, but here's where things get a little weird. Here's a confusing piece of the puzzle. If we're staring down a potential crisis, why is gold going down? I mean, shouldn't it be going up? It seems to fly in the face of everything we think we know about safe haven assets. The answer is actually pretty fascinating, and it's because you've got two completely different groups selling. On one side, you have entire governments, like Turkey, selling off their gold reserves. For them, it's a defensive move. They're trying to prop up their own national currencies that are falling. But then you have the other side, hedge funds and big-time investors, and they're selling gold for a totally different reason. They're cashing in their profits and then taking that money and rotating it into the stock market to snap up those high-quality companies, like a Microsoft, at a huge discount. It's a totally offensive play from their perspective. So this doesn't mean gold is suddenly a bad investment. It's just part of this bigger strategic chess game happening in the market. All right, let's look at one last thing. One more surprising bit of historical data that gives us a really unique perspective on all this. It turns out the type of year we're in, a U.S. midterm election year, has a very, very distinct and powerful historical pattern. Okay, so if you go all the way back to 1950, the median or typical stock market drop during a midterm year is about 16%. Right now, we're sitting at a 14% drop, so we're right in that historical ballpark. But here's the kicker. The average rally in the 12 months that follow that midterm year dip is a whopping 37%. I mean, this chart really says it all, doesn't it? Historically, the short-term pain you feel during a midterm election year is often followed by a really powerful period of gain. Now, nobody can perfectly time the bottom, of course, but what the data strongly suggests is that if you can just hold your nerve and maybe even buy when things look scary, it could be incredibly rewarding down the line. So really, it all boils down to this, doesn't it? In these moments, when fear is just screaming from every headline and seems to be driving every decision, the real challenge, the real opportunity is to take a step back, look at the data, and just think rationally. What we've seen is that, yeah, the risks are absolutely real, but history gives us this incredible guide for not just surviving the turmoil, but maybe even thriving in it. So the final question for you is, are you listening to the noise or are you listening to the data?
If this helped, subscribe for more stock market crash analysis, recession updates, and investing insights for 2026. Comment, crash or opportunity?